oil prices just dropped, and the reason might surprise you. West Texas Intermediate crude fell nearly 1% today, while Brent crude dropped more than 1.5%. The price at the pump is about to get cheaper, and the reason is something that almost nobody expected just a few months ago. The United States and Iran are talking. In the next 10 minutes, I'm going to break down exactly what's happening with oil prices, what the U.S.-Iran negotiations mean for your gas bill, and why this development could change the entire energy market in the second half of 2026. Because this isn't just about oil. It's about inflation, the Federal Reserve, and what it means for interest rates and your wallet. Let's start with what actually happened. Diplomats from the United States and Iran met this week for the latest round of nuclear negotiations. The talks are still fragile, and no deal has been signed. But the mere possibility of progress was enough to push oil prices lower. Why? Because Iran sits on one of the largest oil reserves on the planet. If sanctions are lifted and Iran's oil flows back into global markets, the world's supply increases and prices fall. West Texas Intermediate, the benchmark for American crude, dropped to $75.30 a barrel. Brent crude, the global benchmark, fell to $79.22. Those numbers might not sound dramatic, but a sustained drop in oil prices has enormous ripple effects across the entire economy. Think about it this way. Energy isn't just what you put in your gas tank. It's embedded in almost everything you buy. Shipping costs, manufacturing costs, airline tickets, grocery delivery, they all depend on fuel prices. When oil falls, those costs eventually fall too. For the Federal Reserve, this is potentially huge news. The main reason inflation is still running above 3%, well above the Fed's 2% target, is energy. The conflict in the Middle East has kept oil prices elevated for months, pushing up transportation costs and, by extension, the price of everything that moves. If the U.S.-Iran talks succeed and oil prices fall sustainably, that removes one of the biggest obstacles to the Fed bringing inflation under control. And if inflation comes down, the Fed has less reason to raise rates. Just last week, new Fed Chair Kevin Warsh signaled that a rate hike was possible later this year. Markets immediately sold off. But if oil prices drop significantly over the coming weeks, that calculus changes. Lower oil means lower inflation. Lower inflation means less pressure to raise rates. Less rate pressure means lower mortgage rates, cheaper car loans, and, potentially, a recovering stock market. This is why oil is arguably the single most important commodity for the everyday American right now. But here's what Wall Street is watching carefully. These negotiations have broken down before. The U.S. and Iran have a long and complicated history, and previous rounds of talks have collapsed without a deal. If negotiations fail again, oil prices will almost certainly spike, especially given the ongoing instability in the broader Middle East region. Goldman Sachs analysts have modeled two scenarios. In the optimistic case, where a nuclear deal is reached and Iranian oil returns to market within 6 to 12 months, they project Brent crude could fall to the low 70s. In the pessimistic case, talks fail, conflict escalates, they see oil potentially spiking back above $90 a barrel. That difference from $70 to $90 a barrel translates to roughly 30 to 50 cents per gallon at the pump. For a household that drives 2 cars and fills up twice a week, that's a real difference in monthly expenses. The dollar is also a factor. The U.S. dollar index hit its highest level in over a year this week, driven by Fed hawkishness. A stronger dollar makes oil cheaper because oil is priced in dollars globally. So even if Iranian supply stays off the market, dollar strength alone could keep oil prices suppressed. What should you watch for in the coming days? First, watch for any official announcement from U.S. or Iranian negotiators. A formal statement of progress, even without a final deal, will push oil prices lower. A breakdown in talks will send them higher. Second, watch the weekly U.S. crude inventory report. If U.S. inventories are rising, it signals lower domestic demand and puts downward pressure on prices. If they're falling, it signals strong demand and prices could rise. Third, watch the dollar. If the Fed signals a rate hike is coming, the dollar strengthens, and that keeps oil cheaper even without new supply. The energy market is in one of its most complicated moments in years. The outcome of these negotiations could determine whether inflation continues falling, or whether it stays stuck above 3% and forces the Fed's hand. Either way, the price of oil is one of the most important numbers in the American economy right now, and it's moving. Subscribe to stay ahead of these market moves before they hit the mainstream news. We post every day covering what actually matters for your money. See you in the next one.